Welcome to the Daily Consolidation, your 15-minute briefing on today's market action. Please note that the views shared here are not personalized financial advice and are for informational purposes only. Always consult with a financial professional before making any investment decisions. Now let's dive in. So we're unpacking the action from November 18th, 2025. And what a day. It really felt like every big story we've been tracking just sort of hit a wall all at once.
It really did.
The idea is to get into what's really happening under the surface here. We're looking at, three major narratives, all facing a crisis of confidence: the AI dominance story, the sure thing of a Fed rate cut, and of course the idea that the consumer is just endlessly resilient.
It was a brutal session, no question. The tone was decisively risk-off. This now makes it 4 straight down days for U.S. equities.
That's the longest losing streak since, August?
Since late summer, yeah. The S&P 500 fell, about 0.83%, closing at 6,617. But that's not even the big headline number.
No, the big headline is that technical level, right? The 50-day moving average.
Exactly. The S&P closed below its 50-day. That level has been rock-solid support since late April. That's a 144-day streak. Just, gone.
And when a streak like that breaks, it's a huge signal. It's not just a number. It tells you the whole momentum of the market is shifting.
It's the visual of confidence just evaporating. And, the Nasdaq got hit even harder, down over 1.2%, and the VIX, the volatility index, it just surged. It's holding comfortably above that 20 level.
And we always say, when the VIX lives above 20, you're not in a calm market anymore. That's real anxiety.
It's a different environment entirely.
Okay, so let's start with tech. The AI rally has been the story for months, but today felt different. What was the catalyst for such a sharp sell-off in the megacaps?
Well, the skepticism is finally coming from inside the tent, so to speak. You had the CEO of Alphabet come out and publicly warn about, and this is a quote, irrationality in AI stock valuation.
Wow, from the CEO of Alphabet? That's a big deal.
It's a huge red flag, but the thing that really drove the selling today was a major analyst downgrade that just sort of cut to the heart of the whole thesis.
You're talking about the Rothschild note, the one that hit Microsoft and Amazon.
That's the one. They downgraded both to neutral. And their argument was that this whole narrative, the whole trust us Gen AI, is just like the early days of the cloud story.
Yeah.
They're saying it looks increasingly misplaced. And the key reason they gave is that the underlying economics of actually making money from all this AI spending are far weaker than assumed.
Okay, so that's the critical point. It's not just about stocks being expensive. It's a challenge to the fundamental promise that all this capital spending will lead to massive, quick profits.
Precisely.
It's asking, are they spending billions just to build something that won't have the same profit margins as the cloud boom did?
Exactly. And you can see that pressure building on NVIDIA. The stock was down almost 3% today, and that's right before their big earnings report this week.
Yeah.
The market is screaming, show us the receipts.
Right, prove it.
Yeah, prove that all this spending is actually turning into real, sustainable revenue growth. Because if it's not, that whole thesis starts to look very, very shaky.
And as that tech story starts to crack, the spotlight immediately swings over to the broader economy. Like, can the consumer keep this whole thing afloat? Did we get any hard proof today that the soft landing story is in trouble?
Oh, we got the clearest proof you could ask for. It came from Home Depot. And this isn't just one retailer. It's a direct line into the health of the middle-class consumer and the housing market.
They missed again.
For the third straight quarter. And they didn't just miss, they slashed their full-year guidance significantly.
Forget the cents per share. What did it look like in terms of actual growth?
Comparable sales were almost totally flat. They missed by a mile. And the guidance cut was pretty stark. They went from expecting a small profit decline to now seeing a 5% drop for the whole year.
And the reason they gave?
The CFO was very direct. He pointed to ongoing consumer uncertainty and continued pressure in housing.
So that directly challenges this idea that just pausing rates is enough. Home improvement is usually one of the first things to bounce back when people feel good about housing.
And if they're still pulling back on that kind of spending, it really undermines that whole soft landing narrative. It shows the uncertainty is deep.
At the same time, we saw a clear rotation, right? Where did the money go?
It was a classic flight to safety. Defensive sectors like healthcare showed incredible resilience. You had names like Eli Lilly, Medtronic, all trading near new highs. It confirms investors are ditching the high-growth stories for companies with earnings you can actually see and count on no matter what the economy does.
Okay, let's connect that uncertainty to the Fed. The market was so sure about what was coming next, and now it seems like nobody has a clue. What's the bond market telling us?
The bond market is pure chaos right now. I mean, just a few days ago, the odds of a December rate cut were over 80%.
And today?
Today, it's 50%. Exactly 50. It is a literal coin flip.
What on earth caused such a violent reversal in the futures market? That suggests the Fed itself has no idea what it's going to do.
That's precisely it. You're seeing the internal divisions spill out into the open. We had Governor Waller, who is a major voice, basically endorsing a December cut. He said he's worried about the labor market.
Okay, so that's one camp.
So then, almost immediately, Boston Fed President Susan Collins comes out and says the opposite. She said she'd be hesitant to cut without notable labor market deterioration.
So you have a split right down the middle. One side wants to get ahead of a downturn. The other wants to see the whites of its eyes before acting.
And it's so much harder for them because they're basically flying blind. We have to remember that government shutdown means all the October data is, well, it's permanently impaired. So their big December decision is going to be based on 2-month-old data from September.
That's an incredible amount of uncertainty.
It's toxic for markets.
So if stocks were selling off that hard, you'd expect a massive flight to quality in bonds, right? Yields should have plummeted. Did that happen?
And that's maybe the weirdest part of the day. We saw a total correlation breakdown. The S&P drops almost a full percent, but the 10-year Treasury yield, it barely budged. It fell just 1 basis point, hovering around 4.119%.
That's nothing. So a big risk-off move in stocks, but almost no reaction in bonds. How do you interpret that disconnect?
Well, there are 2 ways to look at it. One is that investors don't think this is a real recession signal yet. They see it as a valuation thing, a tech problem, so they aren't rushing into safe bonds.
And the other interpretation?
The other more concerning one is that inflation fears are still so high that they're putting a ceiling on bond prices. Even with stocks falling, investors are worried that inflation will stay sticky, so they don't want to lock in these yields.
Let's move to the really wild part of the market speculative assets. The crypto collapse today was something else. What happens under the hood when Bitcoin breaks a big number like that?
The structural damage is just immense because it's all about forced liquidations. Bitcoin plunged below $90,000. That wiped out every single gain for 2025. It's now down on the year.
But the real damage is the leverage.
Right. That's the key number. We saw over $800 million in leverage positions get liquidated in one day. $250 million that vanished in a 4-hour window. It was just a cascade.
So that's not people deciding to sell. That's margin calls. A feedback loop.
A toxic feedback loop, exactly. The crypto fear and greed index plunged to 22. That's extreme fear. And it's not just traders. Long-term holders, the HODL crowd, they sold over 800,000 Bitcoin in the last month. That's a serious exit.
Looking globally, what happened in currencies? With a risk-off mood, you'd think the dollar would be strong.
And that's another place things got complicated. The main story was actually extreme Japanese yen weakness. The dollar broke above 155 yen, but the really wild move was the euro against the yen. EURJPY hit an all-time high, breaking above 180.
An all-time high. Why is the yen getting crushed by the euro, of all things?
It's a textbook case of policy divergence. Everyone else has been tightening policy to fight inflation, but the Bank of Japan, even with 3% inflation, has stayed stubbornly easy.
So there's a huge interest rate gap.
A massive gap. It makes holding yen incredibly unattractive, so capital is just flooding out of Japan into anything with a higher yield. That's what's driving these historic moves.
And we saw other weird cross currents too. The dollar index, the DXY, actually fell a bit.
Right, a classic risk-on signal happening on a major risk-off day. And then you had small caps. The Russell 2000 actually rallied midday, adding almost 1%.
So mega caps are getting hammered on growth fears, but small caps are rallying. How does that make sense?
Well, one way to read it is that some investors are looking past the current mess and positioning for eventual rate cuts. Small caps are super sensitive to borrowing costs, so they're betting that the Fed will have to cut rates, which would help that segment disproportionately.
It's like different parts of the market are betting on totally opposite futures.
Schizophrenic is a good word for it. You saw the same split in commodities. Crude oil fell back below $60 on supply worries, but silver rallied hard, outperforming gold.
Which suggests industrial demand optimism, right in the face of everything else.
Exactly. The market is completely torn.
So if you pull it all together, this brings us to the core question. Is this a healthy, necessary correction, or is this the beginning of a much bigger, much more painful repricing?
And the answer to that question really depends entirely on what happens over the next 3 days. The event risk is just incredibly concentrated.
Okay, let's walk through the schedule. What's the focus for tomorrow?
Wednesday is judgment day for the entire AI story. It's NVIDIA's earnings after the bell. The expectations are astronomical. The market needs them to justify not just their own valuation, but the premium valuation of the entire S&P 500.
Which is still pretty high, right?
Yeah, the S&P is trading at 22.4 times forward earnings. That's way above average. And that premium is basically built on the promise of AI profits. So if NVIDIA falters, the whole market feels it.
And then Thursday, we finally get some real economic data.
We get the delayed September jobs report. Remember, the Fed has been flying blind. This is the first clean piece of employment data in months. It's going to heavily influence that coin flip December decision.
So the market will be watching for any sign of weakness.
Any sign of that notable deterioration President Collins said she needs to see.
And Friday, we get a test of the consumer.
Yeah, the University of Michigan Consumer Sentiment Report. This will tell us if those warnings from Home Depot were a one-off or if that anxiety is spreading across the whole country right before the holidays.
For anyone watching the charts, what are the absolute key levels to watch this week?
For the S&P 500, it's all about getting back above that 50-day moving average. That's around 6,650 to 6,660. If it can't, the next big support is down near 6,500.
Okay, and for Bitcoin?
The line in the sand is that $85,000 to $87,000 zone. If that breaks, you'll likely see another wave of forced selling. And finally, for bonds, watch the 10-year yield. If it breaks below the 4.00% level, that's a major psychological shift and could signal much deeper recession fears are taking hold.
What's so fascinating here is that it's not just one thing. It's a crisis of faith across multiple, huge investment themes all at once. And watching how different assets like those weirdly strong small caps are reacting is more important than ever.
That's all for today's episode of the Daily Consolidation. If you enjoyed our analysis, remember to like this video and subscribe to our channel for more daily market briefings. See you at the next close.